Good morning, everyone. As the sun rises over the city and people stream into their offices, a new day begins in the world of finance, a world that never truly sleeps. The stock market is a world of flashing numbers and shifting fortunes, where billions of dollars can change hands in the blink of an eye. Every second, prices update, reflecting the hopes, fears, and decisions of investors around the globe. One day, a company's stock soars to new heights, fueled by optimism or a breakthrough announcement. The next, it tumbles, sometimes for reasons that seem mysterious or even unfair. This dance of ups and downs is driven by a complex mix of news, numbers, and emotions. Headlines can spark excitement or panic, while data releases and earnings reports can shift the mood in an instant. Understanding this ever-changing landscape is key to making sense of financial headlines and the stories behind them. It helps us see beyond the surface and grasp the deeper forces at play. This week, Wall Street offered a vivid snapshot of this constant motion, with dramatic swings and surprising outcomes that caught the attention of investors and analysts alike. We saw a beloved brand's stock fall despite positive news, while two tech companies soared to new records, defying expectations and sparking conversations across the financial world. By exploring the stories of Levi Strauss, Applied Digital, and Elastic, we'll unravel the market's logic, or sometimes its apparent lack of logic, and discover what really drives these dramatic moves. This journey isn't just for financial experts or Wall Street insiders, it's for anyone curious about the powerful forces that move our economy and shape the world we live in, from families managing their savings to entrepreneurs chasing their dreams. So, whether you're a seasoned investor or just starting to pay attention to the markets, let's dive together into the biggest stories of the week and see what lessons we can learn from the ever-changing world of stocks. Let's start with Levi Strauss & Co., a name synonymous with denim and American culture. Founded in 1853, this company has become a global icon, known for its durable and stylish jeans that have been a staple in wardrobes for generations. It's a name we all know and trust, a brand that has stood the test of time. Recently, the iconic jeans maker announced a strong quarter, raising its annual forecast. This kind of news usually sends waves of excitement through the investment community. Typically, such positive news excites investors, leading to a surge in stock prices as confidence in the company's future grows. However, in a surprising turn of events, Levi's stock fell over 6% after the announcement. This unexpected drop left many scratching their heads. It seems counterintuitive, doesn't it? How can a company report strong earnings and still see its stock price fall? The answer lies in the complex world of investor expectations, a powerful force on Wall Street that can make or break stock prices. Levi's drop wasn't due to poor performance. In fact, their business remains robust and healthy. The company is doing well by all traditional metrics. The real issue was that investors had set their expectations sky high, hoping for a perfect score. They were looking for results that would blow them away. When the results came in as merely excellent, rather than extraordinary, it wasn't enough to satisfy those lofty expectations. This scenario is a classic lesson in market psychology. Stock prices reflect not just a company's performance, but also the expectations of its investors. The market had already priced in a fantastic report, anticipating stellar results. So, when the news was just good, rather than phenomenal, some investors decided to sell their shares, leading to a dip in the stock price. Levi's story serves as a crucial lesson in understanding investor psychology. It reminds us that in the stock market, perception and expectations can be just as important as actual performance. To understand Levi Strauss, we must explore the expectations game. This is a contest between companies and their investors. Analysts predict revenue and profit, forming market consensus. A company's success hinges on beating these expectations. An earnings beat often raises stock prices. A miss can drop them. Levi's delivered strong results and raised its outlook. Yet, whispers suggested investors wanted an even bigger surprise. The excitement had pushed expectations sky high. When numbers were good but not spectacular, traders sold shares. This highlights investing's emotional side: hope, excitement, fear, and disappointment. Investing is as much about psychology as financial analysis. Now, let's shift to a story of explosive growth. Applied Digital stock soared over 22% in a morning. Unlike Levi's, this news was met with pure investor enthusiasm. The reason? AI, or artificial intelligence, a transformative trend. Applied Digital operates data centers, crucial for AI's computing needs. The company reported outstanding financial results linked to the AI boom. AI models require immense computing power, driving data center demand. Applied Digital is capturing this growing market, proving its value. Investors saw strong revenue as evidence of its role in AI's rise. This is the opposite of Levi's. Applied Digital's results surpassed expectations. To appreciate Applied Digital, understand data centers' role. Data centers are the internet's physical home, powering our digital lives. They house servers that process and store vast information. AI's rise has increased demand for these power-hungry facilities. Companies need AI-ready centers for high-performance computing. Applied Digital serves this market, growing as AI integrates into business. Investors saw its revenue as proof of its crucial role in AI's shift. This demand is projected to grow, benefiting companies like Applied Digital. Another market winner was Elastic, a software company. Its stock rose over 8%, driven by strong investor confidence. Elastic raised its annual sales guidance, a sign of business health. Impressively, it was the second time in 2 months. This acceleration excited investors, showing solid momentum. Elastic also announced a $500 million share buyback. A buyback reduces shares, increasing remaining shares' value. It's a vote of confidence from leadership, signaling undervaluation. Executives investing in their stock boosts outside investor confidence. This combination of guidance and buyback fueled optimism. The stock price climbed on this wave of positive sentiment. Wall Street has its own unique language, filled with specialized terms and phrases that can seem confusing at first. But learning this language is essential for anyone who wants to follow financial news, understand market trends, or make informed investment decisions. By decoding the jargon, you gain insight into how the market operates and what drives the headlines you see every day. One important term is guidance. Guidance refers to a company's official prediction about its future financial performance, such as expected revenue, profits, or growth. Companies issue guidance to help investors set expectations for the coming months or year, and analysts closely watch these forecasts for clues about a company's health and prospects. When a company raises its guidance, it signals confidence in stronger future results, often causing its stock price to rise. On the other hand, lowering guidance can be a warning sign that challenges lie ahead, which may lead to a drop in share price as investors become cautious. Another key concept is the share buyback. This is when a company uses its own cash to repurchase shares from the open market. Buybacks reduce the number of shares available, which can increase the value of remaining shares and signal that the company believes its stock is undervalued. Investors often view buybacks as a positive move, since they can boost earnings per share and show management's confidence in the business. Fewer shares in circulation can also mean bigger dividends for shareholders. Market sentiment is another crucial idea. It describes the overall mood or attitude of investors toward the market or a particular stock. Sentiment can shift quickly, and it often drives short-term price movements, sometimes even more than company fundamentals. When sentiment is bullish, investors are optimistic and expect prices to rise. When it's bearish, they are pessimistic and anticipate declines. These terms are used constantly in financial news and analysis. News and events, like earnings reports, economic data, or global developments, can quickly change sentiment, sparking waves of buying or selling as investors react to new information. Another term you'll hear is fiscal year. This is a company's official accounting period, which doesn't always match the calendar year. Understanding when a company's fiscal year begins and ends is important for interpreting its financial results. Mastering these terms helps you make sense of stock market dynamics, from daily price swings to long-term trends. It empowers you to read financial news with greater confidence and clarity. With this knowledge, you can better decode why stocks move the way they do, how investors respond to news, and what might happen next in the market. Ultimately, understanding the language of Wall Street is a powerful tool. It opens the door to smarter investing and helps you navigate the complex world of finance with greater ease and confidence. Levi's Applied Digital and Elastic show news fuels the stock market. Investors process company reports, product launches, and economic data. Positive news can spark buying, Negative news triggers selling. Market sentiment filters news, shaping reactions. Bullish sentiment amplifies positive news, as seen with Applied Digital. Stocks reflect both performance and market emotion, creating volatility. Let's summarize the core lesson for new investors. A stock's price moves based on supply and demand. More buyers than sellers raise prices. More sellers lower them. Investors buy based on future value beliefs, sell when losing faith. These beliefs are shaped by new information, like earnings reports. Good news doesn't always mean a stock will rise. It's about expectations. Positive surprises can create buying frenzies, as with Applied Digital. The market looks ahead, guessing future outcomes. Understanding stock dynamics involves real-world performance and investor emotion. It's a world where business, technology, and psychology intertwine.